Welcome back to another episode of Fun Friday with a recurring guest today. We've got Scott Croul. He is in a new position, a new role since he last was on the show. But Scott is someone who I respect a bunch. We have conversations periodically, and Scott's really a problem solver within the commercial real estate business. And he's now with a new team, George Smith Partners. So we'd love to hear all about that. But Scott, thank you so much for coming back on the show.
Greg, thank you. It's great to see you again, and I look forward to our conversation.
Yeah. So, Scott, can you just give everyone your high-level overview? You clearly have gone through some market cycles. You've seen this movie before in reference to, changes in interest rates and kind of sentiment, things like that. But just so the audience can get a grasp if they didn't listen to the first episode, how did you get to the chair you're in today, just step by step from kind of the roles and positions you've held?
Yeah, well, it's been too many cycles, but they all rhyme, but they're not the same. I'll just say that much. This has been an interesting one. Certainly, have been driven heavily by what's happened in the Federal Reserve rate and how it's impacted capital markets in general. The fundamentals, especially multifamily, have been very strong and will continue to be so. And certainly, we're seeing some encouraging words from the current administration as relates to the agencies. It looks like they're going to continue with their vital role, but possibly as a private company that has the backing of the government. So I think liquidity will continue from that perspective, and then we've got all the other capital sources that are really wanting to help take advantage of this market and the fundamentals in multifamily.
Yeah, I mean, I really love that phrase. Not every cycle is the same, if you will, but cycles have kind of some pain points. And I was listening to a podcast. I'll give him a shout out, James Eng. I love his content. I don't know,
Yeah,
Scott, if you're related to James, but he's got great
that's good.
information.
Yeah,
It's especially useful for us because we're Texas people, and he breaks
yeah,
down transaction in Houston, Dallas,
yeah.
obviously the markets that we love to play in. And he also made a comment of Camden, I believe it was, where saying basically that, I will make a point or maybe it was either Arbor or Camden, but I think it was Arbor, which is saying that this has been the longest cycle of kind of a downward trend. He said typically, or Camden or Arbor said typically they're 16 months, 18 months. It's in, it's out. We've been on basically a 3 year, 36 months long skid and kind of downturn. But the fundamentals are getting better as we speak. Supply is getting chewed through depending on the market that you're in. There are some anomaly and outliers that have not recovered that well, albeit in Austin, some pockets in Nashville and Phoenix. But, the Dallas and Houstons have been quite resilient and are looking up and better. So we're getting through it. It's been about 3 years of negativity at the moment. But boy, oh boy, I'm ready for some positive or just normalcy within the multifamily world without a doubt.
Yeah, well, it's really kind of missing the point, and that is we're seeing really strong absorption. It's just that the deliveries have just been overwhelming in those markets that you pointed out. There's still strong absorption. The economic drivers continue to move the markets and are attracting all kinds of tenants and really fueling that absorption. So there are players out there that are now looking in those markets as viable investments, investment parts of the country. It's not only just on the investor side, but also on the lender side that people are not shying away from the markets. It's just really trying to figure out where the bottom is on some of these rents. The trends are still a little soft, but we're seeing some areas where they're stabilizing.
Yeah, I mean, it's just interesting. It's a perfect storm. You've got rates went from zero interest rate period environment on SOFR to, of course, now north of 4.3% there. You've got record supply levels coming online, and then you got operating expenses that have got a lot more, pricey and insurance costs, labor, things like that, which just really hurt your expense ratio. So those three drivers right there are very difficult. But one positive driver is, of course, replacement cost has never been higher. So it's harder to, build a structure, particularly affordable housing, call it, 80 to 2,000 product in good markets. You really can't build that for a reasonable number. So obviously all the new supplies is a product, and people are moving up asset classes right now, generally speaking, from renter base, if they're moving. But actually, we've seen recently that people are actually staying in their current
Yeah.
assets. They're staying. Renewals are actually getting really, really good. Obviously, it's no secret that it's very expensive to move. It's time, it's money, it's energy. People are only really moving if they have to, but those are good signs because, of course, to turn over a unit costs several $1,000s at times. So, getting a tenant, renewing a tenant, even breaking even is probably, you could argue, more profitable than getting a bit of a rent bump there, if you will, depending on the skill you're doing it at in your business plan. So, things to consider there. But, Scott, let's talk about what you were doing before and then now what you're doing at your new role and position.
Yeah, sure. So, so before I was working at Peak Hill Capital, going into that, I had uh, varied roles as fund manager. I was running the Western region for Freddie Mac multifamily. And at Peak Hill Capital, we launched to really kind of fill that gap that I was describing earlier, where there's a need to rebalance a senior loan in order to refinance, or just you're not able to raise LP equity and come in with bridge financing to fill those gaps. Uh, Now with George Smith Partners, I've got access to all those preferred equity sources, but also can handle all the other parts of the stack. George Smith has been really a leader in structured debt. I've been familiar with them since I got in the business, and they've been really on an expansion mode since 2022. The company was went through a change. New leadership came in with new capital, and we've really have been building a national footprint. We brought on a mortgage banking platform as well as a C-PACE platform. And then we have our own equity funds for LP and GP capital that we're deploying to help our clients fill out their capital stacks and take care of their capital needs.
Right. So let's talk about kind of some of the deals and kind of the structuring. What are you promoting out to people right now? What seems to be the assignment that you're getting to kind of capitalize some of the deals? Like, talk to me about, the solid fits that you're doing and some deals that don't make sense, maybe.
Yeah, so certainly the biggest requirement out there today is equity. So we're seeing a lot of need for LP equity or a desire for LP equity, and that's a little bit harder to find. The preferred equity is seems to be where those investors would rather be, and just have that extra layer of insulation. And so we're seeing those kinds of assignments, and then we're also seeing the senior financing that goes along with it. It's across all asset classes, and we're seeing that for new construction as well as for existing.
Right. So are you doing, I know obviously there's some people that are doing new deals, but quite frankly, transaction volume has been quite stymied this year, and will probably stay slow for 2025. I think 2024 is a skosh more active than this year has been, depending on the market you're in and where you're looking. For us, it's been quite slow at Lone Star Capital, but I don't want to only be talking our book. But I imagine a lot of people right now that you're working with, Scott, are reaching out to you, trying to maybe extend their kind of current deal, buying themselves time, because the two things you need in any real estate deal for it to work out or just to stay afloat is money, cash, or time, right? So can you talk about maybe some of the recapping of deals that you're doing or pref infusions you're doing into deals, and kind of some ways you're getting creative with a lot of owners there, if you will, to kind of keep their deal alive and to kind of extend them and grant them more time?
Yeah, so I'm working on a deal right now that is exactly what you described. We've got a loan that's it's maturing, but they've got one more extension remaining. They're not nearly finished with their business plan, and they need more time in order to execute it. This is a property in California where it's harder to turn units over because of the laws here, and so they need that extra time. Rather than just do a 1 year extension and then have to go back to the well in a year, they'd rather just do a whole new loan that gives them the entire period necessary in order to execute their plan. So we're looking at a couple options. One's an agency with pref, and then the other one is a bridge loan that would be able to get them closer to the full proceeds that they need. We'll be able to top it off with our own equity and get them cash neutral in both situations. But that is, I think, really going to be kind of one of the major drivers we're seeing this year is people that maybe they're at the maturity completely, or they have that extension and they're trying to kind of recapitalize in order to finish their business plan and get to the exit.
Right, makes sense. And that's kind of one of those things right now where a lot of people bought their deals in 21 or 22, maybe even 23, right? So if you bought your deal in 21 or 22, there's a good chance that you may be in a point where, depending on how levered up, if it was bridge, you could be so underwater it's not salvageable. There'd be a couple of deals that maybe you did a 5-year fixed rate, 7-year fixed rate on, that you're looking around like, hey, we're not gonna be able to exit this at the point we want, so we might as well get maybe more term. Maybe you're doing a deal that you've got a bridge on and you have to go bridge to bridge, perhaps in 23, right? So there's a lot of people who are kind of looking around and say, hey, we need to act. We need to do something. Like, the time is now. And that's also another theme from the James Zane podcast that I took away from it. Not that we didn't see this from our experiences, but it's just kind of the idea of we're not waiting around anymore for anything to be more perfect. The market is kind of the market for the better or the worse. Are you kind of seeing that where people are like, okay, now is the time to do something because we've waited so long?
Yeah, I think you're absolutely right. We're kind of getting to the recognition that this is the new normal and there's nothing to wait for. If we want to execute our plan, let's just do it now and get it over with. Let's really kind of set our course rather than just kind of bumping along the can getting kicked down the road. So that's really becoming I think, a driver for a lot of business for all of us right now, where we're seeing that recognition. And a lot of the existing lenders are they're kind of exhausted with the deals they've got. So they want to see them off their books, and it's creating an opportunity for new capital to come in where, bridge to bridge was kind of a bad word a year ago. Now it's something that it's kind of our business, it seems like. So it's definitely transition from a market where everybody was holding on and nobody wanted to do bridge to bridge to where that's, I think, going to be a big driver of volume for 2025.
So can we talk about that real quick? What bridge to bridge means, and kind of the people who got themselves in those situations, like when they bought those deals, just for kind of a holistic outlook as to someone who might be in that camp there. We don't typically do bridge deals in our end unless there's a very unique situation, because our models do not do massive turnarounds there, if you will.
Yeah.
That often is why people do bridge, just for those who maybe are not as privy to this, not as known to how the finance structure and world goes. So, I guess, could you just give a breakdown as to the profile and kind of the acquisition timeline, roughly when that deal was bought, the structuring of it, and why they need to go bridge again, if you will?
Yeah. So as the market heated up, we saw a lot of people justifying their purchase prices or able to win their acquisition bidding contest by compressing cap rates with the justification that there's loss to lease and that they can do all this value add, and we're actually buying at a much higher cap rate than it looks like. And so the optics kind of made sense. And so we saw that really drive a lot of business going into 2022 and then suddenly rates spiked. And we saw a lot of people that actually did execute on those plans. They were able to recapitalize or sell their assets and do very well. Some of them, and I had an instance where someone executed their plan, they did everything right, but they locked in a Freddie Mac floating rate loan in 2022 rather than a Freddie Mac fixed rate loan in 2022. And their cost of capital just went through the roof. And then they wanted to refinance out into a fixed rate when it was time to pay for the next rate cap. And it was going to be cash in. The market was soft, even though their property was outperforming the market. This was a deal in San Antonio. It was a kind of a declining trend. We saw the rent roll at less than the T1. We saw the T1 less than T3. We saw the concessions going through the roof in 85 vintage
If there was a chart, it was not going the direction you hope it would go, is
Well,
what I'm hearing.
exactly. And so but they were outperforming the market. They were like 90% economic occupancy in a market that was more like, you know, 85%. But it's
And
like,
we know San Antonio is a tough market to play in right now.
yeah, so like we're not going to be able to underwrite that. We're going to underwrite what's going on in the market. We don't see it bottoming out and leveling off. And so we weren't able to get the proceeds because of what the market was doing. And as a result, they ended up just buying a rate cap and trying to ride it out. And it was I think a situation now where it's just gotten worse for them because they've been really hampered by the debt service requirements. It's impaired their ability to turn units and really cover a lot of the other capital requirements of the property operations.
Yeah. So with those properties, I mean, they're going to go bridge to bridge. How many more years are they looking to get on this? What's kind of their outlook? Are they doing this just to keep the deal alive, or are they doing bridge to bridge because they think on the other end of this, they can make a lot of money once the market kind of clears up there, if you will?
I don't know if they think they're going to be able to make a lot of money. A lot of it's just preservation of capital. They know that, and some of them are still like, well, we've tried a capital calls and it didn't go anywhere or it barely went anywhere. And we've been propping the property on our own to compensate for that. But at this point, we want to just be able to get to the exit, and we want to do it with preserving and making as much money as possible. But the I think the real driving force is really preservation of capital. So they're looking for some way to just ride this out. Give me 3 more years. I want to get out of this asset as quickly as possible, but I think I need at least 3 years. I don't know if I want to be in here for 5 years. So that's where the floating rate starts making sense. It's like, okay, if we do a agency fixed rate with maybe preferred equity, we're looking at a painful exit due to the prepayment. And if we can go with bridge, and we've got some flexibility there that's more aligned with our desire to just kind of ride this out and get out as quickly as possible.
Right, makes sense. So if people are going, on the capital stack there, switching gears here, people are going on the capital stack here for agency and then pref in there, and you guys provide that. What are, the rough going in rates there on the, today on, let's say, a 5-year deal, 7-year deal on, call it a fixed rate deal, and then what are the pref terms that you guys typically put out?
Yeah, so the agencies are able to get pretty low on the spreads if you're willing to buy it down the rate. So we're seeing spreads under 150, down to 135 or so, with a rate buy down on a 5-year term, with some interest only, generally a couple of years. Then we're seeing the preferred equity weighing in, I'd say anywhere from like 12% to 14%, kind of in the middle range. You might be able to get below that, and there's plenty of people that would like to get more than that. But that's where we're seeing a lot of the competition come out. We're seeing last dollar exposure limits. They're really looking towards the exit with debt yields somewhere in the 7+ range, ideally 7.5 to 8%. That's and it really depends on the market. If it's a highly liquid market where they feel confident in a sale and at a favorable cap rate, they'll lean more into the debt yield and go lower down. If it's a less liquid market, they're going to be looking at that agency refinance as their primary exit and be looking at maybe a little bit higher of a debt yield.
Right. So you mentioned that it's around 12 to 14% on the pref. What's the current pay and accrual on that? Because that's very competitive. I mean, if you think, for the record, if you're looking at an apartment and you got conviction that you can maybe make this a 3-year 18 IRR, well, that's a pretty great return that you can
Yeah.
skim if you got no comment in it other than your own dollars as a principal, right? That's pretty competitive and reasonable, I would say. Particularly right now, if you look at kind of where we're at cyclically speaking, it's when the market's not very fun and the fundamentals are pretty heinous, like what we've seen the last couple of years, that these pref deals, and the capital structure there could really make a lot of sense. So can you go over the accrual and the current pay that you typically are giving out there?
Yeah, so we're seeing current pay roughly about half of what the total preferred equity amount is. It could go below that. We've seen the idea of maybe just having a sweep to, so it's not a hard pay, so it's a sweep to a seven, and then if they participate after that, or it accrues after that. And so there's some flexibility to where there is the ability to effectively have less than, kind of the target current pay, almost like common equity, but without the profit participation at the back end. So your promote structure for the common equity is greatly enhanced by the limit with the total preferred rate.
Yeah, and cash flow sweep can be very interesting. So that means basically, and if there is deals where you think there is good cash flow on it, like if you think you get to an 8% or 9% and you got good conviction on a deal, you're not paying very much on the back end there. And you could be really collecting a lot of back end comp if you're a sponsor or owner operator, lead GP there. So it's just something to think about as these times change. It's interesting that pref is that competitive at the moment. I remember in 2023, a lot of people were offering, somewhere or trying to get somewhere between 16 to 17% on
Yeah.
pref, which is silly if you think about it because those deals are probably not going to be north of a 13 to a 15 IRR. So, yeah, of course, if you're a pref person or if you're an institution trying to generate some capital in return, well, yeah, you'll just keep all the equity upside, right? But, right now it's starting to get more competitive, which makes a lot more sense. And just generally and holistically, Scott, are you seeing yields and projections of yields not as high, I guess from an outlook perspective today than you were maybe beforehand, just because where debt is currently?
Well, are you talking about yields like IRRs or
Yeah,
what's
IRR or AAR, IRR, are you seeing really much difference there, if you will?
uh, not necessarily. I mean, I know that there's certainly some capitals looking for higher returns, and so I mean, if especially in certain asset classes like hospitality and things like that, the IR requirements have to be very high to get anybody interested, and it's really just hard to get anything to pencil as a result. But for the multifamily, it does seem like it's been held fairly steady. I'm not seeing a lot of changes there. It's just that uh, it's really hard to get anything to pencil these days with interest rates where they're at and how that's diluting the IRR on the investment.
Yeah, I mean that's the thing is, most of these deals tend to be like a 15 or so, but when debt's, kind of more expensive, it's tough. On to, I guess, we obviously know we're in some tough times right now, but can you give us some optimism here? What you're seeing that maybe is getting you excited about the market? It's very clear that we've been in a tough situation, in a tough place, fundamentally speaking, but is there light at the end of the tunnel from what you're seeing? What is getting you optimistic right now?
Well, for multifamily, absolutely. The supply chain or the supply of new inventory is greatly diminished. I mean, it's practically frozen in some markets, but demand is still there, and we are uh, not even close to solving our housing crisis across this nation. So the fundamentals are very strong on a general basis. Certainly, we've got some lag of to lease on some of the new inventory, but we're I think getting close to the bottom in just about all the markets that saw the major supply come in, and so the long term I think is really very positive for everybody, and it's just a matter of uh, when you're ready to enter the market. At this point, there are investors that are considering and looking at places like San Antonio and Austin. I've talked to a number of investors that say they really like those markets. So we're looking past kind of some of the bumps today at the more at the horizon, and people are, I think, very positive.
Yeah, I mean, it's very interesting times. Of course, that's not really a hard or hot take there, if you will, but it's challenging to kind of look through everything that's gone on right now because so many people are getting very defeated with past deals that they've been in that are operating at a very tough level, or a lot of capital calls happening. But unfortunately, that happens. So there's good deals coming up. But what's interesting is we've kind of are changing our buy box to a little bit better product. But what's fascinating is that who's also looking there is everyone else, and a lot of the
Yes.
institutions. So we've seen a lot of institutions actually been players on deals where last year we bought three deals when the market, I think, actually probably bottomed from a buyer perspective in 24 and 23, 25. A lot of these big shops are really looking around and saying, well, we need to put our money around. We need, we're not we don't get paid to have idle cash, right? And especially if you're working with pension funds, stuff like that. The market now is the market, and they're looking around. And the byproduct of that is 90s and 2000s vintage, call it 1990, 2010 deals, which was our wheelhouse last year. We acquired, several deals in that kind of bucket. Those deals now are very competitive, and a lot of them are actually being bought cash. And a lot of people are saying, you know what, screw it, we can just solve for, call it a 11 to 13% return, and we're happy with that for good product. So that higher quality stuff, the newer asset stuff that a lot of people want, is getting very competitive. But there doesn't seem to be that much of a market right now for, call it 80s, certainly 70s, but 80s and maybe early 90s stuff right now, which is just interesting. Are you seeing that as well, Scott, on your end?
Yes, absolutely. That's a very good point. There's definitely a bifurcation based on asset quality, and we're seeing institutional investors are really shying away from pre-90s vintage. So, the 70s and 80s vintage, it's really hard to raise capital for that. Certainly, there's plenty of liquidity on the debt side, but it's getting much harder to get investor interest overall in that sector. A lot of those deals, have come to market, and I think they're going through a painful period of um, price discovery because there's just not many buyers or any buyers really showing up, and a lot of those deals have been really just kind of languishing on the market, whereas the newer stuff, 2000 or newer, is really kind of right in everybody's sights. And like you said, it's it's more of a battle. It's kind of like pre price spike or rate spike atmosphere again in those asset classes.
Yeah, and I think a lot of that is in large part due to kind of the world that, Lone Star does play in to a certain extent. Kind of in the group of, hey, we don't have necessarily one institutional equity backer there, if you will. We syndicate capital, right? We raise money on a per deal basis. We have never fallen short on a raise, which is awesome, but we raise money for deal per deal basis. And a lot of these deals that are the 70s and 80s vintage assets are bought by groups that maybe are not doing so right now, kind of the more
Yeah,
syndicators that maybe don't have the biggest portfolios. Maybe they got into the business not too long ago, and those are the owners of them, and then the buyers of them are the same kind of people that are going through that cycle there, if you will, that are looking to get their first, second, or third, or fourth, or fifth deal maybe, and they can't make these deals work right now. They can't make them pencil. They're struggling to raise capital for those deals because the hot money is not in the business. So it's really created a market where that B minus C plus kind of range asset, kind of the more older product there, if you will, is really struggling because it just doesn't have a market because there's not many buyers there, as opposed to, a deal that we were, looking to acquire. Well, guess what? Cortland bought it all cash. We can't
right.
compete with that. They're buying it all cash. And if you're a seller, of course you're going to take that offer. We're just not competitive. So they can buy it all cash. They can stabilize it. They can do their, improvement there and then refi it there. So, it's just kind of a tale of two cities with assets at the moment, is what we've seen and experienced this year. Last year, we had the ability to do some tax exemption opportunities, buy really great deals when there wasn't as much of a presence there, and we're really grateful for it because of the success that's going on currently of those assets. But it sucks because we want to buy more of them, but it's just very difficult to make them work at the moment.
Yeah, and so I'm just curious how the HFC legislation is going on right now, how that might push deals into the market that are newer assets, but they were bought with that abatement in mind, and could go through some serious distress if they don't have that.
Yeah, I actually can comment on that. So there's two ways these deals were done. So we did it directly through the city. So those aren't the deals that are under issue there, if you will, to our knowledge and understanding. But we did it directly through the Houston Housing Authority in
Yeah,
jurisdiction. It's the out of jurisdiction deals that are problematic. But exactly to your point, there could be some carnage if that gets revoked in 2027 or so, where those deals get that clawed back and stripped for them. A lot of deals were bailed out due to tax exemption structure. So that could be a really good buying opportunity there, if you will, but that could cause definitely problems in some sectors within the multifamily market there, if there will, if it's not done correctly. A lot of those deals were acquired either obviously newly or were refinanced with that and hope to preserve, which I respect anyone doing that. You had to do what you had to do to kind of stay afloat, but it's certainly going to create some big long-term problems there, if you will. And that's just challenging for those operators there for sure. So that could definitely have Texas kind of be problematic in that 2027 window, but it will also create a lot of the assets that we have within our portfolio that much more valuable, particularly if this goes away. We don't know where it's going to go. We'll be on the cutting edge of it at Lone Star because that's one of our niches, but it's definitely challenging for a lot of those people to come. It'll be very, very, very fascinating. But yeah, to your point, there could be some fireworks there coming up without a doubt.
yeah. Well, fortunately, Texas is a very solid market, so I'm sure there'll be no lack of buyers for the newer inventory that we're using the traveling HFCs to make it work. But we'll see. It's definitely going to be a interesting thing to watch.
Yeah, without a doubt. Scott, so before we let you go, this has been a fun conversation as always with you. What are deals that you're looking to do right now with your new group? What are some deals that, the George Smith Partners teams would like to do? How you can help people, how you can solve people's needs? Kind of walk us through how you've been helping people and what you look to help people with, throughout this year and beyond.
Okay, thank you. Yeah. Well, we play in all asset classes, and we've got now a mortgage banking platform. So we've got access, and we service life insurance company business, as well as just clearing the capital markets. We've been arranging joint ventures and other equity investments and new developments, recapitalizations, and acquisitions across various asset classes. Our equity fund launched at the beginning of this year, and I think we've got two deals that are scheduled to close here in the next couple of weeks. These were recaps of existing multifamily deals. And then we're doing just regular equity or debt placements, bridge and perm across all the different asset classes as well. We're seeing a lot of demand, mostly on the refi front. Acquisition activity's been light, but we're thinking that we're starting to see some price discovery, and we're going to be looking at that increasing as time goes by.
Excellent. Well, Scott, what's your email? How can people reach out to you or kind of best connect with you and, give all that information if you would, please?
Oh, sure. Thank you. It's J.S. Croul, Croul, at gspartners.com.
Awesome. Scott, thank you so much for coming on. I look forward to obviously making you an annual visit on the podcast here, if you will, to share the latest and greatest in your insights. You've been a lovely guest, and we look forward to seeing you in the not too distant future. For the listeners here today, we appreciate your time. We'll see you next week.
Thank you very much, Craig.